Okay then, very good morning. It is 26th of March, Monday, and so I hope you all had a good weekend. Hope you're ready for another trading week ahead. A few things to get you up to speed on from a news perspective, and then I'll hand you over to my teammate Sam, and he'll look at the market as usual a little bit more from a technical perspective. So really, I'm just going to jump straight into the news and have a look at what still is the main topic of debate, and that is the situation about trade and the US's objective following this kind of protectionist route. And that really is what's dominated the weekend's press, because things like Brexit, obviously having secured that transitional deal, is kind of a little bit on the sidelines for now, as they've kind of reverted back to discussing things like Northern Ireland until really the next June summit. So just having a look at the charts this morning, and you can see the dollar a little bit weaker once again, as this kind of trade issue is the, as I said, dominant theme. So consequently, in the top left-hand corner, you've got euro dollar up testing at R1. And you can see that was the high print that we've tested overnight in the Asia Pac session, up at around that level. And then cable also similarly around R1 this morning. So both pairs on the front foot. Equities, though, it's going to be quite interesting, and we'll have a look at that from a broader perspective after I've covered this kind of trade issue and given you an update, because there are a couple of things to consider for this week, because we've got quite a light calendar of scheduled events, but of course it is month end and quarter end, and we'll look at the charts in a second. But obviously we've had a pretty big sell-off last week, and it'll be interesting to see if we get a bit of a bounce just going into that quarter end period, if we are seen as a little bit oversold in the context of recent moves. But let's just have a look at some of the headlines firstly, and this is it. The US seeks deal with China in bid to avert the trade war. So just to give you an update, the Treasury Secretary Steven Mnuchin said he is optimistic that the US can reach an agreement with China that will avert the need for President Trump to impose tariffs. Obviously, this was something that was tabled last week, of putting tariffs on China of at least $50 billion of goods from the country. And so a little bit of more, I guess, a diplomatic route being followed now, some conversation about, look, this is what we're threatening. We don't have to do this if you make some concessions on your side. Mnuchin said he's cautiously hopeful that they'll reach an agreement on an interview on Fox News on Sunday. This, of course, comes after last week China unveiled tariffs of around $3 billion on US imports in response to those steel and aluminium duties that were brought about by Trump a few weeks ago. In terms of the specifics, so I guess if you were monitoring the news as this negotiation, if you like, develops, the list includes a reduction of Chinese tariffs on US automobiles, more Chinese purchases of US semiconductors, and greater access to China's financial sector by American companies. So this is what the US are kind of lining themselves up for. But if you're looking at the charts this morning, again, the market with really a lack of any other major fundamental narrative to latch onto, the trade situation really is still at the forefront, and as such that does give you a bit of a bias, at least on that side of things, of dollar weakness could potentially continue, at least for the foreseeable future, unless we get some kind of diplomatic resolution in the short term to ensure that these retaliation effects from the likes of China, which they were threatening last week, and then other global trade partners, doesn't materialize. That would be the one thing I'd say that you would need to support the dollar from this ever lower trend. The other thing, of course, is spending bills being passed in the US, but a lot of people, I've just been reading various things at the weekend talking about the ever increasing negative fiscal situation in the US, which also would be indicative of a weakening dollar from a more structural point of view. So there's plenty of reasons about dollar weakness at this point. I guess the only more positive thing would be the Fed, and they were talking about, although overall perceived last week as dovish, they are or have executed a 6th interest rate hike, with 2 more to come this year and more the subsequent years thereafter. So For the moment, I'd probably be more positioned for an extension of dollar weakness and monitoring this event as a key thing. Just having a look at cable, because that's been quite interesting. I was just looking at the cable chart this morning. I know Sam will look at this a bit more thoroughly in a second, but obviously we've got above that high point that we're seeing. This would have been the end of last week in the afternoon. That's kind of the weekly high, and this obviously tells the story of the transitional deal largely being the main catalyst for the move higher in the pound last week. So crisis averted, at least for now, on the Brexit issue, in combination with very strong improvements in the wage data. The Bank of England at this point seems on course for a May hike. Don't forget, all of this conversation, of course, comes in the context of a weaker dollar. So with that in mind, I think you've got to be favourable for further upside tests. And looking technically in cable, you've got the high print of the year. Well, first of all, we'd have to get our heads above the high from last week when we saw that flash move on the 7-2 vote split from the Bank of England. We printed up really about 40 pips or so away from that price point at the moment. Any break above there, you've got the year-to-date high at 143.70. But if I start looking more longer term, this is looking at cable on a 5-year chart on the axis at the bottom. And I think what we can't rule out now that the short-term fear about a complete breakdown in Brexit negotiations has been, as I say, averted, at least for the time being, I do think that there is potential for quite a bit of a decent move higher in the weeks, months ahead, potentially for cable, particularly if we continue to see this belief of a deteriorating fiscal situation in the US amid record debt levels, with large-scale spending programs by Trump. And it's almost a dual fold, because then he's upping the ante and the rhetoric from a trade perspective, as well as potential geopolitical conflict with having John Bolton, who's very direct in dealing with issues such as North Korea, who he's to see soon, and also Iran, which we'll get onto in a second, which has been a focus over the weekend. If then that was to materialize, I'd be keeping an eye, as I say, on that year-to-date high in cable. And then beyond there, 145.60. So then looking at the 2015, so we're going back to pre-EU referendum levels now. We're going all the way back to April of 2015. And then I really struggled to see, or I should say, high probability, I think, this where we were trading pre the fall on the night of the referendum. I don't see any reason why that can't be tested. 148. I didn't think I'd be saying that a few months ago, but that kind of double bottom that we had back in 2013, pretty decent level around that 148, and then ultimately a full recovery, of course, would be the 150 handle, which was where we were trading the night of the referendum. And as I say, fitting this belief is the Bank of England are due to deliver an interest rate hike in May as well, and so the markets will need to be positioning for that accordingly. So, as much as I hate to say it, Sam is on the right side of cable. Theresa May remains for the time being. Alright, a few other things to have a look at. And just quickly, this is oil. This is a headline you might have read from the weekend and this morning. So quite interestingly, there's been 7 ballistic missiles that Saudi Arabia has intercepted. I'm looking at the details, but presumably this is the Houthi militia firing from Yemen. So I guess let's just quickly bring up Saudi Arabia on a map, just for those who are less familiar with the territory here and what exactly is going on. So, all right, hopefully you can see a map now on my screen. So we're looking at, okay, so again, the context, and we're looking at this in regards to oil. Now you've got Saudi Arabia, which is obviously the largest of the producing nations within the OPEC 14 countries. But within OPEC, there's 3 kind of major countries when it comes to production, and that is, of course, Saudi, Iraq, and Iran. Kuwait is actually number 4. So if you actually think about the top 4, OPEC producing nations, they're all neighboring amongst or surrounding the Persian Gulf Sea. This is the Straits of Hormuz coming out around this peninsula part here, out of the Gulf of Oman, and so on and so forth. Now, what's happening, and this did happen, I guess, a few months ago when Saudi originally had the corruption purge with the changing of the guard, from a senior level, kind of promoting MBS, Mohammed bin Salman, in the leadership of Saudi Arabia, in this kind of vision of Saudi 2030, cleaning up internally so that they can encourage foreign investment for the long-term kind of, or to facilitate a more diversified income for the country other than just being one-dimensional on oil. But what happened was quite interesting, and it seems to be happening again, is that the missiles are coming from Yemen. Now, this is from the Houthi militia, who are backed then by Iran, and this is where the problems come. Because as we know, Saudi Arabia and Iran have a very, there's a lot of tension historically, for reasons I'm sure you're aware of. But this is obviously very key, because when the US get involved, and the US is an ally of Saudi, and now you've got John Bolton, don't forget, is now one of the main guys who has taken a pretty firm stance previous occasions in his commentary towards Iran, and so any new sanctioning here, then this is why oil could be quite sensitive to the upside and developments on this issue. Now, the one thing is, when we look at the oil chart, it did rally overnight. This is probably in the initial response. So if you actually look at midnight, when the futures trade reopened and we had a bit of a chance to react to this news, we did see about a 30-cent spike at around the open electronic trade. We got up to R1 before we've seen a pretty decent about turn. Now, technically, that little spike that we had overnight in the recommencement of trade, you can see here, we're coming up to really the upper bound of the year-to-date high. So technically, that level does have some significance for crude oil, you can see. And I guess if we start going even further back, I mean, the last time we were up at these levels, of course, this is that really big fall going back to, well, if I just remove some of these lines just on Sam's computer at the minute, so just bear with me. Okay, so you can see how important that level is in oil that we're testing at the moment at the year-to-date high, because above here there really isn't a great deal of technical levels. So this was, of course, the big move that we had when US shale production was really starting to pick up, and the OPEC strategy was, well, we're not going to cut to counteract this fall in prices. In fact, let's do the opposite. Let's cut wholesale prices and let's continue pumping at high levels in order to squeeze the US out of the market. The price obviously dramatically fell from in excess of 100 all the way down to the lower bound of kind of 40 and below thereafter into 2016. And it got to the point where really OPEC had no choice but to start stepping in, cutting in large size. And as you know, the compliance levels now between OPEC and non-OPEC, we're looking at about 145%, the highest it's ever been. And so, it's an interesting situation to monitor, because irrespective of US production going up and up and up, which should, you would think, alter the supply side of the argument, this geopolitical tensions, and this doesn't help that Donald Trump as well putting in more aggressive stances, particularly with his personnel on that front of foreign policy. It could be destabilizing and consequently supportive of oil. And this is in the broader backdrop as well, although there's trade fears of an improvement in global economic growth as well. Don't forget, more demand on that side. The thing is, though, if you look shorter time frame, oil has backed off. Now, one thing to be aware of is that if trade talks do escalate, don't forget, this is basically bad for everyone, because global growth would be in jeopardy in that sense, because it doesn't just damage the US, it would damage China, Western Europe. Everyone would suffer if it was to escalate. The other thing is, and Gavin, you're talking about this, and just to give you an update, China has now launched its own long-awaited renminbi denominated oil futures contract. That's gone live today. Now, what does that mean? So just to give you a bit of a summary of what exactly this is. So don't forget, China is the world's largest crude importer. And what they're seeking to do is extend its influence over the pricing of barrels sold into Asia. Now, China imported about 8.4 million barrels a day last year, and that outpaces the US's 7.9 million. Now, after establishing itself as a leading buyer of physical barrels, China has ambitions to exert the same power over trillions of dollars traded each year in oil futures contracts. So the country is also seeking to make its currency a bigger player on the world stage. Don't forget, the bigger long-term objective, of course, is that if all things remain equal, that at some point in the future, China will overtake the US as the world's largest economy, and by default, then this whole liberalization of the Chinese framework of its stance on foreign policy, its domestic openness to foreign investment now through improvements in technology and infrastructure, all of this is so that China can be a bigger player on the global scene. And it's imperative then that their currency becomes a real possibility of the global reserve currency knocking off the dollar. Obviously, this isn't going to happen anytime soon, but things like the yuan's addition to the IMF basket of currencies is kind of the first step to that, what happened a few years ago. Now, the aim, of course, for China is to take some of the control away from the West and away from US dollar-based international benchmarks like West Texas Intermediate and Brent, so that prices reflect as closely as possible the crudes processed by Chinese refiners specifically. So should we be concerned? The FT note that big Middle Eastern producers will be monitoring the performance of this Chinese benchmark closely over the next few years, as it could face pressure from Chinese buyers to adopt the marker for pricing of their crude. Now, obviously, this would have severe consequence for the demand of Middle Eastern crude in that respect, if they're using the Chinese product as their reference point for pricing of crude. Don't forget, as I said, China imports 8.4 million barrels a day last year. That is by far the largest in the world. Now, who can trade this product? Well, you guys can't, not unless you go through JP Morgan. To give you an idea, the contract is open to Chinese and overseas investors and more than 150 domestic brokerages, along with 10 foreign entities. And the only one probably that you would recognize as a more household US name is JP Morgan. So again, it's not something, I'm not pinning this on the reason why oil has pulled back, but it definitely does have long-term implications for certainly the Middle East and particularly Saudi Arabia. If Saudi Arabia wasn't already under pressure to diversify their economy, this is just only something to add to the necessity to make that change for them. All right, quick look at the calendar and the week ahead, and I'll hand you over to Sam. One thing to keep in note, and this is what I really wanted to mention, is that this week in economic calendar, what I'm showing you now on my screen, if I transition, the week is very quiet. Now, one thing to keep in mind is I just want to go back to the S&P, because if you look at the S&P in the context of last week, so I'm just going to put this on a 350 chart. So I'm just looking at, if I put where we were from last week at the kind of reopening of trade on the 19th, we basically fell about 6.2% from high to low last week. We have recovered some of that, but we're still down about 5%. On the month, we're down about 3.7%. Now, is this at a point where it has become a little bit oversold? And if you're of a belief that the market, at least at this point, has priced in the rhetoric coming out of the US administration on the likes of the trade talk, and remember, Stephen Mnuchin at the weekend was being a little bit more diplomatic. We can avoid this. My hope is a solution. We want to avert a trade war. That's from the Treasury Secretary himself, who, as we know, is closely aligned with the president. Is a bit of a yes man in that respect. So if that is the case, what I'm suggesting then is there possibly some room for the upside and a bit of a reversal back higher as the market digests then the kind of on the month, we are down. If you look at the quarter as well, because this is the importance, it's also quarter end, of course. And overall, if we have a look at that from a percentage basis, we've gone from really opening at the beginning of the year. So here we're down about 2.6% to current price, and from the all-time high, we are down about 9%. So it will just be interesting to see whether or not we get a little bit of kind of rebalancing into that period toward the end of the week, given the context of the fact that it's particularly quiet for an economic calendar. The other thing to bear in mind as well, I'm not sure if you guys noticed, that on the train on the way into work this morning, particularly quiet. And that's because, of course, it's the school holidays. And this does have a bit of an impact on trading volumes. So not only is the calendar light, if you were a banker on a big desk, this is the ideal time to go away. So therefore, trading volumes also generally could be quite light. All right, going to hand you over to Sam then, and he'll have a look at a few of the charts. That calendar of the weekly events, though, is in your inbox if you need it. But otherwise, have a good day and have a good week ahead.
Yeah, good morning, everyone. Hope everyone had a good weekend. Let me just get we'll start off with pound today. Just going to put it onto a 60-minute chart just to get closer to where we are trading. Let's put the pivots on here. So just having a look at this, you can see actually just at the moment pound is pushing to a new high. You've also got for those that do look at the dollar index, is pushing to a new low. So the dollar's coming under a bit of pressure here as pound just not a million miles away from 142.50 and even closer then to Thursday's high that we saw there. Does seem quite a long way away now, but in terms of a half decent area, the pivot, which was also sort of Friday morning's high, and then the low area around there does look technically pretty good. And you've also got in the mix, let me just go from a bit lower down around here, could well be that that's this sort of trend line meets up as well with the pivot point. Don't necessarily think we're going to get that at the moment, so it's one to bear in mind. And in terms of pullbacks to possible levels of support, obviously R1 you have here, but also the high, and I'll just circle it up again to make it a bit clearer, the high from Friday and then this morning 142.22 on the futures. If you were to come back to test that area, you could expect some support around there for a further push on to the upside. Just before the high that we had on that Thursday, the Bank of England, you have the R2 to bear in mind as well. A continued push through there, and then we're at levels not seen since the back end of January, beginning of Feb. So one to keep an eye on there, 143.44, not out of the question really this week if we continue this trend that we've been on since the beginning of March. But as you can see, there's been pullbacks each and every few days. So just, it's not necessarily going to be just one complete straight line. And like when we saw in equities at the beginning of the year, I would expect pullbacks here and there. So definitely one to keep an eye on. Would favour the upside though for now. Speaking of trend lines and pivot areas, euro doesn't look too bad. You've also got the lows around this morning and what were previous highs. I know we did get chopped through, but not the worst area around there, because you also have a bit of a trend line that matches up from there as well. Let's just get that on, going from the lows around here, matches up quite nicely, and you could have a decent test around that area, the pivot previous lows of the day, to look to get continued push higher, especially if you're getting the continued dollar weakness later in the afternoon. To the upside, you can see just above the high of today you have the high of the 15th, so sort of first test of that, and we've come back down since. Push through there, and then the previous day, the 14th, wouldn't be out of the question. So it could be a decent opportunity on continued perhaps momentum, looking for a push through to the upside, and a decent target area already in mind. In terms of levels to the downside, if we were to look for area support, you can see we've already sort of chopped through the previous highs of the day. They offered a bit of support, but nothing amazing. You've got a couple of, let me just get the rectangle up again. A couple of these support points here. The one I think that I prefer the most is looking around here, 124.47, just where this move really did start from. I'd expect a decent pop of support here for a further push on. Going over, looking at Aussie dollar, which has sort of bottomed out after this move that we saw at the middle of the month. Of course, obviously this is the last trading week of this month, something I'll come on to in a bit. R1 already broken through to the upside. You've got R2 and the high of the 22nd, and then the the original high of the 22nd, and then the afternoon sort of morning 22nd high around that R2 would be quite interesting. Obviously, keeping in mind the low that we had last week, and the low for quite some time, marking up today quite nicely with S2. It's quite a range-bound market over the last couple of trading days, so I wouldn't be expecting a massive break either way. You can see we're technically respecting yesterday or Friday's high quite nicely. It'll be interesting to see what happens around this R1 as well, which was the previous high of the day. Quite a few support and resistance levels. I'm not sure there's going to be a sort of a trade that you perhaps want to be in for a long period of time. As you can see, there was quite a few turning points in this market of possible interest. From a risk-reward perspective, you know, if we do get a push above, well, today and Friday's high, it opens the door to the this point here in the market. 1 second, that could be a decent opportunity, or you know, even if you wanted to wait and look for that area to continue the overall trend as well, I think that's a decent trade idea. Having a look at the yen, so just not a million miles away from quite an interesting level, which was Friday's high and Thursday afternoon's low. That's just above today's R1. I have to keep an eye on that. Probably get some sort of trend line going on there that we broke through today. Let's just have a look if that was respected. So let's just have a look. Nah, it's pretty messy really, even this one. I wouldn't really be too interested in that, see if that's an area of support. I prefer to really look to go short on dollar yen, but probably at the moment just a bit higher up. You've got a couple interesting areas of potential resistance you can see around this point in the market just before the R2, where the move on the back end of Friday started coming down. That would interest me as well. But again, you know, if we do start to see maybe some dollar strength come back into the market, it could be that you're looking for these levels, you know, to break. But overall sort of trend of this market really, since, you know, 30 and ranging down, I would prefer to look to go short there really. Moving over US equities, I'm just going to put this onto a weekly chart. Let me just clear everything up there. So you can see a couple down weeks in a row. Obviously just having a little bounce early this morning, and the last time we had 3 down weeks in the S&P was back in April 2016, I think. Yeah, April 2016. You can see here, obviously nowhere near as big a size of the move as we're seeing now, but something to bear in mind, especially, you know, you're going into the last few trading days of the month. Could see a bit of a bounce just based, you know, purely on that bit of profit taking into the final few days of the month, and also obviously the quarter. But yeah, last time we had 3 down weeks in a row back, well, literally 2 years ago. Going into a shorter time frame, you can see once I put these pivots on from Friday's trading day, it's coming up to some interesting resistance points from the back end of Friday now. 26.29 a quarter looks quite interesting in the futures there. Something to bear in mind, which also translates over to the Dow as well, probably a bit higher up, but you can still see all that sort of area, and the Nasdaq as well. I guess probably actually performing the best so far. Actually, one thing to bear in mind as well as we do come back into this downtrend of recent, is probably worth getting on some sort of trend lines just to see if we do mark up anytime soon. You know, got a couple of areas to be aware, and Nasdaq perhaps outperforming just a bit, so keep an eye on that when trading the Nasdaq, when trading the S&P and the Dow for sure. Have a quick look over at oil, which is just coming to the pivot, first sort of test of that. One to bear in mind, I mean, the pivot doesn't look actually too bad. He had a bit of support on this point on Friday afternoon as well. Let's just get a couple of trend lines on here. We can see we broke through to the upside on Friday afternoon. That would mark up sort of with $65. Let's see if we can get another trend line using these lows. It's not that bad, I guess. 65, and well, it does seem perhaps a bit mid-rangey, but something to bear in mind there. You can see having broken through to the upside, could look for an area of support around there at $65. I think the trend is still to the upside. You know, even when we sort of go sideways for a bit, the oil at the moment just is determined to push higher. So ideally, if you can get that lower down, I think that would be the best sort of trade to look for there. Of course, volume is gonna improve into the afternoon, and with the clocks going forward yesterday morning, cash open is back to normal time of 2:30, and the oil increase in volume around 2 p.m. as well. So just to bear in mind, as the last couple of weeks have been slightly different. Any questions, as usual, please do get them in the chat, and I'll be having a look throughout the day as well. If I don't speak to you, have a good trading day, and obviously good luck for the week.